Welcome back to the Deep Dive. Today we're looking at a set of financials that, quite frankly, they make me question the efficiency of the entire market.
The efficient market hypothesis. It doesn't always hold up.
It usually does, though. But today, it feels like we're looking at a glitch in the matrix. We have a company here with what I'd call Class 1 metrics of looking at the data you sent over. Return on equity ROE of over 55%.
Yeah, that's an incredible number.
And operating margins are pushing 40%. In my world, in the hedge fund space, you pay a massive premium for that. You'd expect a PE multiple of 5, maybe 30.
At least. I mean, those are basically software numbers.
Exactly. But this company, it's trading at a PE of around 11.5. It's arguably one of the most profitable operations in its sector, yet it's priced like a distressed asset.
Right.
It's like finding a Ferrari on a used car lot with a Honda Civic sticker price. And everyone's just walking past it thinking the engine's missing.
That is the perfect setup. And you know why they're walking past it? Because they remember what that Ferrari looked like 10 years ago when it was, quite literally, a rusted-out wreck.
We are talking about AngloGold Ashanti, ticker symbol AU.
We are, and I want to set the stage here because you're looking at spreadsheets and seeing a financial anomaly, maybe a pricing error.
That's what I see.
But when I went through the technical reports, the geology surveys, I didn't see a finance story.
Oh, what did you see?
I saw an engineering miracle.
Miracle is that's a strong word for a gold miner. I mean, we're usually talking about digging dirt and hoping for the best.
Yeah, that's a strong word, but hear me out. The transformation here, it isn't about digging better dirt. It's about how they've re-architected the entire business model. They've gone from this sort of chaotic, high-risk operation to something that looks, well, it looks a lot more like a semiconductor fab in terms of precision and control.
Okay, that's a big claim, comparing a hole in the ground to a clean room. So our mission today is to tear this apart. We need to figure out if this structural inflection point, as the analysts are calling it, is real.
Right. Is it a permanent shift or just a lucky run with high gold prices?
Exactly. We have a 12-step framework from the source material, and we are going to stress test it.
Let's do it.
So let's start with the DNA, segment 1, the shift. Because for the longest time, AngloGold was the South African miner, formed in 2004, deep roots there. But looking at the corporate filings from late 2023, that company doesn't really exist anymore.
No, it doesn't. And this is the part a lot of people miss. In September 2023, they didn't just change their letterhead. They executed this massive corporate migration.
To London and New York.
Headquarters to London and the primary listing to the New York Stock Exchange.
I want to pause there because that sounds like administrative boredom. We moved the office. But from a capital flow perspective, this is nuclear.
Why is that? You're the money guy. Why does the zip code matter so much?
It's about mandates. There is a massive South Africa discount. If you're a giant pension fund in California or a sovereign wealth fund in Norway, you have strict risk rules. You often cannot hold a primary listing in an emerging market like that.
So they were just locked out.
Completely. Trillions of dollars of global capital were legally forbidden from touching it.
Yeah.
By moving the ticker to the NYSE, they effectively unlocked the gate. They made themselves purchasable by the S&P 500 crowd.
But a new address doesn't fix a broken business.
Exactly my point. So you have to look at the performance. And the turnaround narrative here is just, it's stark. I went back to the 2013 data just to see how bad it was.
The dark ages, as the engineers call it.
It was a bloodbath.
Yeah.
I mean, negative EPS of $5.68. The company was hemorrhaging money.
It was a classic case of chasing ounces. It didn't matter if it cost $2,000 to get an ounce of gold out of the ground as long as they could say they produced it. Pure volume over efficiency.
And now, you fast forward to the trailing 12 months data. EPS is a positive $4.56. Net income over $2.2 billion. How do they even do that?
They treated their portfolio like a tech company. If a product, or in this case a mine, had high costs and low yield, they killed it. They sold off those super deep, expensive South African assets.
So they shrank to grow.
They shrank to become profitable. Which brings us to the winners. You have to understand how they're mining now. This is where my engineering comparison comes in.
Okay, segment 2, the fab visit. You've got notes here on Obuasi in Ghana and Geita in Tanzania. What's so different about these mines?
Right. So I want you to picture a traditional mine. You're probably thinking of thousands of guys with pickaxes, dust, heat, chaos.
Man, that's the movie version.
Erase that. Imagine the intensity of a chip fabrication plant. A fab, but buried 2 kilometers underground. The source material talks about deep-level automated mining. We're talking about zones with such extreme rock pressure and heat that a human couldn't survive down there.
So, how do they get the gold?
They don't send people in. They send robots, remote-controlled drilling rigs, automated loaders. This isn't just tech for the sake of tech. A human needs breaks, gets tired, can't work. When safety alerts go off, a robot runs 247. It's continuous manufacturing.
So the factory never stops.
Correct. And that connects directly to the yield. In the semi-world, yield is everything. In mining, it's grade, how many grams of gold you get per ton of rock you process.
And the numbers on Obuasi, they jumped out at me. The grade is 10.91 grams per ton.
Which is... it's just absurdly high.
Put that in context for us. What's a normal mine?
Well, a standard open pit mine might be 1.0, maybe 1.5 grams per ton. AngloGold's own Iduapriem mine runs at about 1.33. So Obuasi is running at nearly 11. It's almost 10 times the concentration.
So for every ton of rock, you get 10 times the revenue. but your cost to process it is largely the same.
That's it. That's where the margin explosion comes from. But there's another metric here that I think is the most important engineering stat of all, TIFR.
Total recordable injury frequency rate.
Right. In 2016, that number was 7.71. That's high. It implies frequent stoppages, accidents. In 2024, it's 0.98. It dropped below 1.
Which is a huge humanitarian win, obviously.
It is, and that's the most important part. But if you look at it coldly, from a pure efficiency standpoint, safety is speed. Accidents stop the line. If you cut accidents by 85%, your uptime explodes. The machine just doesn't break.
Okay, so the machine is running smooth. Let's talk cash. Segment 3, the financials. And I'm going to play devil's advocate here.
Go for it.
Gold prices are at record highs. Everyone in the sector is making money. Is AngloGold just riding the beta? Is this just a generic gold play?
That is the lazy analysis. If you look closer, the differences in the AISC, the all-in sustaining cost.
Define that for us clearly.
It's the total cost to produce 1 ounce of gold and keep the mine running. Diesel, labor, maintenance, everything. Now, we've had massive inflation. The cost of mining has skyrocketed for everyone.
Right, so margins should be getting squeezed.
But look at AngloGold. They've kept their AISC controlled at around $1,600 an ounce. While their peers saw costs blow out, they held the line. That's the automation. That's the high grade at work.
And that creates operating leverage. If the price of gold goes up 10%, but your costs stay flat, your profit, it doesn't go up 10%, it might go up 50%.
And that's exactly what happened. Look at the operating margin. In 2023, it was around 12.5%. The trailing 12-month number, 39.84%.
Nearly 40%. That's Adobe. That's Microsoft. Heavy industry is not supposed to do that.
And it goes right to the bottom line. Free cash flow.
This was the number that made me spill my coffee. TTM free cash flow per share is $7.81. That is almost a 10x increase year over year. A quantum jump in cash generation.
So what are they doing with it? Because mining management teams are notorious for, lighting cash on fire.
Well, first they cleaned up the house. Net debt to EBITDA is 0.21x. For anyone listening, anything under 1.0 is healthy. 0.2 is basically zero leverage risk. It's a fortress balance sheet.
Okay, so they paid down debt.
And they have a policy to pay out 50% of that free cash flow as dividends. They are actually returning capital.
So a safer company, printing more cash than ever. But here's where it gets really interesting, because if you stop there, you miss the hidden picture.
This is the connector moment. Segment 4. Because there were 2 news items in the source stack that seem boring on the surface. But when you put them together, a completely different story emerges.
You're talking about the Sentiment acquisition and the exploration in Nevada.
Yes. So Sentiment gives them the Sukari mine in Egypt. Okay, another great African asset. But then you look at Nevada, the BD district.
The Silicon and Merlin project.
Right. Now connect the dots. 1, they move HQ to London and list in New York for legal safety. 2, they buy a top-tier asset in Sentiment. 3, they find this massive resource in Nevada. We're talking nearly 13 million ounces.
I see where you're going. It's a geographical pivot.
It's more than a pivot. It's a funding mechanism. It hit me when I looked at the cash flow. They are using the massive cash flows from their African cash cows, Obuasi, Geita, to fund the construction of a safe haven empire in North America.
That is a powerful reframe.
Think about it. They are literally digging gold in Africa to build a fortress in Nevada. This changes the entire fundamental equation of the company. This isn't an African stock anymore.
It's a North American growth stock.
That just happens to be self-funded by African assets. You're laundering risk into safety. Africa pays the bills. Nevada builds the future. And that brings us to valuation. Segment 5. Because the market has not priced this in.
The institutional debate.
There's a massive valuation gap here. Let's look at P/NAV price to net asset value. Basically, what's all the gold in the ground worth versus the stock price?
The report we have says the P/NAV is around 0.2x.
0.2. That means the market is valuing the company at 20 cents on the dollar for its assets. The big North American majors, Newmont, Barrick, they trade closer to 1.0x NAV.
So it's a huge discount.
It's a huge discount. And even on a PE basis, AngloGold is at 11.5x, while Newmont is at 14 or 15. The market is still applying that scary Africa penalty.
Even though they're building in Nevada.
Exactly. But you flagged something else about that Nevada project, something about inferred resources.
Yes. This is a technical mining term with huge financial implications. Right now, a huge chunk of that Nevada gold is classified as inferred resources.
Okay, translate that. Use the Lego block analogy.
Okay, inferred means we've scanned the box of Legos. We know the red bricks are in there, roughly how many. Reserves means we have counted every single one, inspected them, and we know exactly what we can build.
And reserve is the magic word for bankers.
Correct. Reserves are bankable. Inferred is speculative. And here's the catch. A lot of financial models and algorithms value inferred resources at 0.
So when that paperwork gets stamped.
When those resources get upgraded to reserves, which the feasibility study is aiming to do, the denominator of their value changes overnight. The market suddenly sees the gold that was there the whole time.
So you're buying the cash flow machine today at a discount, and you're essentially getting one of the largest new gold discoveries in North America for free.
That's what the data suggests. It's a classic information asymmetry. The engineers know what's in the ground. The financial algorithms haven't priced it in yet.
It's the gap between engineering reality and financial reporting. That's the inefficiency we started with.
Precisely.
So let's bring this all together. From the DNA shift to London, the fab-like efficiency, the margin explosion, and this hidden pivot to North America.
To summarize, it's an engineering victory. They maximized the grade, automated the danger, and controlled the costs when no one else could.
And from my side, it's a capital allocation masterpiece. They cleaned the balance sheet, moved to where the money is, and are pivoting the whole portfolio towards safety.
It really is a structural inflection point. The fix is done. Now they're just scaling the new machine.
Which leads us with the final thought for our listeners. We see the data, we see the 55% ROE, but the ticker is still trading like that risky African operator at an 11 PE.
The market has memory. It remembers the losses from 2013. It takes time for the market to trust a new narrative. Institutional inertia is a real thing.
The question is, how long does this efficiency lag last? How long before the market wakes up and realizes the transformation isn't coming soon? It's already complete.
That is the billion-dollar question. When does the transfer student get recognized as the valedictorian?
Exactly. And just a reminder to everyone listening, we are analyzing data. We are digging into source material to understand a structural inflection point. This is not a recommendation to buy or sell.
Always do your own homework. Read the 10K. The real gold is usually in the footnotes.
Couldn't be truer. Thanks for diving in with us. We'll see you on the next one.
See you then.